Welcome back to the channel, where we break down complex financial concepts into understandable insights. Today, we're diving deep into a comparison that many of you have been asking about: fixed-rate mortgages versus adjustable-rate mortgages, or ARMs. If you're in the market for a home or looking to refinance, it's crucial to understand the nuances of these two mortgage types. So grab a notepad, because by the end of this video, you'll have a clearer picture that might just help you make an informed decision. Let's start with the fixed-rate mortgage. As the name suggests, this type of mortgage locks in your interest rate for the duration of the loan, often 15 to 30 years. This stability is one of its most attractive features. With a fixed-rate mortgage, your monthly payments remain constant regardless of market fluctuations. This can be particularly beneficial in times of rising interest rates, as you won't be affected by increases that could significantly raise your costs. Now, let's talk about liquidity and accessibility. Fixed-rate mortgages typically require a higher credit score and may demand a larger down payment compared to ARMs. This means they can be less accessible for first-time homebuyers or those with less than stellar credit. However, once you secure a fixed-rate mortgage, your payment structure remains predictable, providing a sense of financial security. On the flip side, we have adjustable-rate mortgages. These loans often start with a lower initial interest rate compared to fixed-rate mortgages, which can make them attractive to buyers looking to minimize upfront costs. In fact, many borrowers opt for an ARM when they plan to sell or refinance before the adjustable period kicks in, often within 5 to 7 years, allowing them to benefit from lower payments without facing long-term risks. However, liquidity and accessibility with ARMs come at a cost. While the initial rates can be enticing, they typically adjust after a set period based on market indices, which means your monthly payment could increase substantially after the initial fixed period ends. Understanding how these adjustments work is crucial. If you're not prepared for potential rate hikes, your financial planning could be thrown off balance. Now let's examine profitability. If you're financially savvy and can predict market trends effectively, an ARM might present opportunities for savings in your early years of homeownership. Yet this comes with inherent risks. The unpredictability of future payments can lead to budgeting challenges down the line, especially if interest rates spike unexpectedly. Risk assessment is another key factor to consider when choosing between these two options. A fixed-rate mortgage offers predictability and peace of mind, shielding you from market volatility and allowing for consistent budgeting over time. In contrast, ARMs carry an element of risk that could result in significant financial strain if rates rise sharply. It's vital to ask yourself, how comfortable am I with uncertainty? Your risk tolerance will largely dictate which option may serve you best. Let's not overlook the psychological factors involved in this decision-making process. A fixed-rate mortgage provides a sense of stability, something that many homeowners value deeply. You know exactly what your payments will be each month. It's simple and straightforward. Conversely, ARMs can cause anxiety due to their variable nature. Even if the initial rates are appealing, some borrowers may find themselves stressing over future payments as they approach adjustment periods. Finally, as we reflect on both options, the predictability and stability offered by fixed-rate mortgages versus the lower initial costs but potential risks tied to ARMs, it's clear that neither choice is inherently superior. Rather, it depends on your individual financial situation and goals. So here's my call to action. I want you to take a moment and think critically about what matters most to you in your financial journey. Are you seeking stability and predictability? Or are you willing to navigate some risks for potentially lower initial payments? Share your thoughts in the comments below. Let's create a dialogue around these choices. Your experiences could help others who are facing similar decisions. Remember that whether you choose a fixed-rate mortgage or an adjustable-rate mortgage, understanding both options fully will empower you to make informed decisions that align with your financial goals. Don't forget to like this video if you found it helpful and subscribe for more insights on navigating the world of finance. Until next time.